Hello, good morning. It's Jeffrey Christian of CPM Group. It's about 11:30 here in New York on Friday, the 12th of July. I want to talk about gold and silver markets and go through some of the statistics of what's been going on in the futures contracts, as well as overall prices. And in addition to that, I'll talk about the consumer price index and producer price index that came out. Basically, I want to talk about silver deliveries, what we've seen, what we haven't seen, silver inventories. That you put those together and you can see that what was going on with the deliveries that were taken on the futures contracts were not fabrication demand. It didn't represent solar panel manufacturers scrambling to take up the silver that otherwise is in the market. Also, let's talk about gold open interest, because what we're seeing, in our view, is that institutional investors and others who are involved in the futures market are preparing for a period of tighter supplies and higher prices in the last few months of this year. We've seen this kind of pattern before. Saw it in 1999, where you saw one bank take a delivery of a large amount of gold on the COMEX in the August contract. And people were saying, why are they doing that? Because that bank is a big physical trader of gold and silver and platinum group metals. If they wanted to buy, I think it was about 600,000 ounces, they could buy that within a week in the OTC market and no one would see that. Ergo, the fact that they used the futures delivery process in the August contract to buy that gold and take delivery of it was that they wanted the world and the market to see that they had that gold. They were, CPM Group at the time, July 1999, was saying we could see tight liquidity in the gold market in September-October period, and the price, which was trading around $250 at the time, $270 at the time, could spike sharply higher going into the October COMEX contract. In fact, it did. It went from like about $260 to $270, and then it went to $340, and then within a week it was back below $300. We saw it in 1999. We saw it in 2016. Those are just two examples of what we've seen, and we could see it again. With inflation and its impact on gold and silver, we saw lower CPI on Thursday, and gold and silver prices spiked sharply higher. We were thinking that we'd see some profit taking on Friday morning, and we did. PPI came out, and it was also weaker than a lot of people expected. And you're in this place now where lower inflation is correlating with higher precious metals prices. There are people who always say, well, inflation and gold and silver prices go hand in glove. They rise together, they fall together. But what you're seeing right now is lower inflation statistics are more bullish for precious metals, because market participants are saying to themselves, lower inflation is a precursor. It's an indication that the Fed is going to lower interest rates. That still is, it's getting more closer to the point where that might happen, but it's still a lot of wishful thinking, a lot of hoping and believing rather than thinking, maybe. We do see lower interest rates coming, but not that soon. And Fed Chairman Powell basically said the same thing this week, and people interpreted it the way they wanted to. There are signs of economic weakness that could lead to lower interest rates later this year, this year. Video note, Tuesday we won't be doing one of these videos because we have the live briefing and release of our 2024 Platinum Group Metals Yearbook. I'll mention it again at the end. it's a free briefing online, and it's live next Tuesday. So let's just look at it. Gold prices have continued to trade in that 2,300 to 2,450 range. We did see the price rise over the last several days. It spiked higher on Thursday to about $2,425. CPM Group issued an ultra short-term trade recommendation to take profits and go short, with the expectations that you'd see profit taking today. We had a target of $2,400. The price went below that this morning, so now we have issued a new ultra short-term gold trade recommendation saying go long, because we are looking at the political environment in the United States, political developments in other parts of the world, and economic conditions that we expect to see next week. And we think that you probably will see the gold price move a little bit higher. And frankly, as we're speaking, it's about $2,411. So it's regained about half of the decline that we saw this morning. We're still playing gold from a longer term perspective on the long side, but you do see these kinds of short term activities there. Silver, very similar. We finally got to our $32 level. The price spiked up. It was off $1 this morning. And again, we do think that the price will head higher later. But, this just sort of points out the vulnerability of the price for silver. Here's some statistics looking at the July COMEX futures. The top part are COMEX silver metals depositories, and this is as of the 10th of July, so Wednesday. And total registered stocks had gotten as high as 70.6 million ounces on Tuesday. On Wednesday, there was 1.2 million ounces that was transferred from registered to eligible. So you had 69.4 million ounces of registered stocks. On a combined total, when you plug in the eligible stocks, 298 million ounces, 298 million ounces. So what we've seen is an increase in the amount of silver that is in COMEX registered depositories. There was 1.2 million ounces that was transferred from registered to eligible yesterday, or 2 days ago. That metal has stayed in the depositories so far. So you're not seeing, that large open interest, 733 million ounces in the July contract at the end of May, and then it got down to variable levels. It's down to 29 million ounces remaining as of yesterday. That's the data in the bottom. You haven't seen that metal leave the depository. It's changed hands. It's changed ownership. But it is still there. That tells you it's probably not fabrication to begin. That's silver. But I also want to point out, here we are, COMEX open interest. Now, as I just showed you, the July contract is now down to 1.3 million ounces of open interest left in the COMEX contract. September's up to 660, and about 129 million ounces of open interest in December. Gold, August is an active contract. 29 million ounces of gold in open interest in the COMEX inventories. So, and then another 18 million ounces in December. So what you're seeing is, as I said earlier, probably mostly institutional investors and financial market participants are looking at the state of the world, and specifically they're looking at the state of the U.S. elections. And they're saying, almost doesn't matter who wins the presidency, It's going to be bad for the United States. It's going to be bad for the world, economically and politically. We have two bad choices being presented to us right now. And you have, with the Democratic Party, the likelihood that you're going to see a tremendous amount of uncertainty over the next few weeks and really probably the next few months because of disarray within that party. And in the Republican Party, you have a lot of clouds hanging over it with the Project 2025 and other issues that are going there. So you're probably going to see a lot of political uncertainty and a lot of investors saying, given the choices that are being presented to us, we probably should have more gold and silver in our portfolio and our wealth than less. So we expect that this will be one of the major factors driving gold and silver prices sharply higher in the next 5 months, 6 months. Turning to the inflation data, the U.S. consumer inflation numbers continue to decelerate, and they've come down in the last month or two at a rate faster than a lot of people in the market had expected. The headline inflation continues to decline faster or decelerate. It's not that prices are falling, it's the inflation is decelerating. The rate of price increases is slowing down. And the headline continues to outpace overall all items excluding food and energy in the deceleration that's going on. It's very broad-based. Earlier in the year, you saw greater deceleration due to energy prices declining. Now you're seeing energy prices declining, but you're also seeing food prices declining. And then you're seeing also broader-based things, non-food, ex-food and energy. You're seeing broader-based deceleration of inflationary pressures, signs that the economy is maturing. This is year over year. If you look on it on a month-to-month basis, which really gives you a much better view of what's really going on now, or last month and the last 2 months, rather than year over year, you can see that the CPI was flat. There was no change in the all items in the headline in May, and it actually declined in June. So again, deceleration of inflationary pressures, disinflationary pressures, getting back to better economic conditions in terms of inflation, but also a sign of growing economic weakness and activity. I will say here, I don't have any unemployment data here, but I noticed that gold promoters are now talking about worrisome unemployment figures because the unemployment rate has gone up to a historically low level of 4%. That's just not something that we should be worried about right now. That's consumer prices. On a producer price basis, relatively flat. They still upward pressures on prices in the services sector, the provision of services, specifically in transportation, but also in non-transport too. On a goods basis, the producer price index is showing greater weakness, and it actually declined, for 4 months, late last year, early this year. And then if you look at that on a monthly basis, you can see more readily that we're seeing another round of declines in producer prices for goods, even as the services remain somewhat positive, but less inflationary pressures here than you're seeing in the consumer price level. Next week, we will not have one of these videos. We will have the Platinum Group Metals Yearbook and briefing. You can go to our website, cpmgroup.com, and sign up to plug into that live briefing. which will have a question and answer period so that people can ask us questions. I know that from time to time people ask us in the comments about these videos about platinum and palladium and rhodium, and we tend not to focus on those because we've been telling our clients for some time that we think the bloom is off those roses and you should focus as an investor on gold and silver. You can go to our website, you can sign up for that. You can buy our books. You can pre-order the Platinum Group yearbook. You can order the Gold and Silver yearbooks. You can get a lot of free reads and videos there. We do monthly videos for Monex, and they are being posted on our website now, so you can see them. And you can send us an email at info@cpmgroup.com if you want to talk about how we can help you better manage your price exposure to precious metals. That's all I have for now. Have a good weekend. We'll talk to you next week, and we'll be talking about platinum and group metals on Tuesday.